Good morning, everyone. Today is Wednesday, October 28th, and this is our weekly internal strategy call for Zacks Professional Services. Last week, we talked about record levels of debt and the fact that it looks like we're definitely going to have more debt on the way. And if we ever wanted to push the limits of how much stimulus in the system it was going to take to trigger inflation, we're on a pretty good course to test that theory. So again, to pick up from last week, total public debt as a percent of GDP is now over 135% and growing. And what does this mean? And what does this mean for wealth management and financial planning in the post-COVID era? So this morning we wake up, and obviously, COVID-19 cases are on the rise again. The market's selling off. We know that's a given, right? We know our portfolios have been built for this, specifically from the core equity perspective. And we know that that the Earnings Certain portfolio, that family of portfolios and our tilts are made for this environment. But we have to start looking out now, a year and even more to determine what our next moves are going to be. And it's important to take a look back at history now to see exactly how we got here. And so if we look at treasury yields going back all the way into the 70s, and in the 70s, remember, we had this period of stagflation, and we had a gentleman by the name of Paul Volcker, who was Fed chair back in the early 80s, specifically, when he basically took all of the Federal Reserve ammunition to basically tame inflation. And so specifically, Paul Volcker, starting in 82, I believe it was, started the initiative, and rates have been falling and inflation has been slowing ever since. And you can see that it actually started in September of 81 is where we peaked. And then it's literally just been cascading ever since. And we'll get these little cyclical peaks and troughs, but the overall trend since basically 1981 has been this collapse in rates and obviously inflation slowing. So remember from our call last week, we're looking at 10-year treasuries, 2 years and 30 years. And obviously the 2 years in black, and in order for us to start really getting excited about some sort of an economic upturn, from a yield curve perspective, we want to see this green line, which is the 30-year treasury, start outpacing the acceleration in what you're seeing in the 10-year. And that obviously hasn't happened yet, but we need to start thinking about it, because it is possible that with all of this fiscal and monetary response required to combat COVID-19, that it might finally be that nail in the coffin we've been waiting for to end this fixed income bull market. And so what we need to do as advisors and as Zacks professionals that work with advisors every single day is we all need to have the courage to challenge these traditional asset allocation models. And what I mean by that is some bullet points here, right? So the 60-40 stock fixed income models, the traditional models, these are obviously now more correlated than ever. Everybody experienced that in the COVID crash. Stocks and bonds both liquidated together. And so this was kind of the shot across the bow to advisors and to all of us that we need to start challenging our traditional thought processes going forward. So again, we've seen the evidence that the benefits of the traditional stock bond diversification are becoming more muted now that bond yields are so low. They're just not offering that same cushion to equity volatility. And speaking again, what I spoke about last week, and I have it highlighted here in blue. If the U.S. economic growth were to remain subdued, right? So it could be any number of scenarios. We know that the Federal Reserve doesn't want to experiment with negative yields, but let's just say that the 10-year ends up at zero. We've only got about 7% upside left in these bonds. So that's going to be basically the best case. And if we have inflation and we return to growth, which is what we all hope for, if that yield goes back to 2.5%, which is what we would consider obviously more normal, you're talking about the 10-year note standing to lose about 16% of its value. So there's some risk here, and we need to basically challenge these models and challenge the idea of this this yield on the risk-free rate, because it's becoming a real issue for money managers. So I've got some of my thoughts that I've put down here, and we're going to go through these. And I think that you guys are going to find these very interesting. I think our clients are going to find them interesting, and I'm hoping it spurs some real good discussions for all of us. But one of the ideas is obviously consider reducing your bond allocations across the board, across all of the asset allocation models. I know I've done this personally. I know many advisors have done this as well. I think probably one of the best things our advisors can do, and this is where they're going to be leaning on all of you as Zacks professionals, if you will, is to guide them to seek input from the ETF model portfolio allocations themselves. Even if they don't want to use our ETF model portfolios, Nina Mishra and her methodology that she uses along with Zacks Investment Management, that whole process of building those ETF model portfolios is so solid. And those ETF selections themselves across that risk return spectrum that we present in advisor tools is really invaluable, even if our clients are only looking to cherry pick certain ETF selections to fulfill a particular mandate. Those ETF models can be useful for that as well. So keep that in mind, and obviously be prepared to discuss that. The best advice that we can give to anyone in a rising inflationary environment is to stay off the long end of the yield curve. We want to favor shorter to intermediate duration bonds. Generally speaking, this helps to reduce interest rate risk, which obviously preserves capital, and it also reduces volatility. I really like TIPS. I like select municipal bonds. There are certain ones that I don't favor. The ones that I favor are obviously going to be, the infrastructure-backed muni bonds, the high-quality munis, and same thing with high-quality convertible bonds. I mentioned these last week. When you start lifting the hood on the higher quality convertibles, you'll find that a lot of these are in some of our growth sectors, including technology, and they all feature that embedded call option on the underlying equity. So you're protected on the downside with the bond characteristics, and then to the extent you can participate in upside equity appreciation, you can convert that bond into an equity position. So those are going to be really good alternatives to the traditional fixed income asset, if you will, asset class. So I'm also recommending here, obviously, the use of ETFs and mutual funds are fine to fulfill this mandate. But you definitely want to use the Zacks ETF ranks and the Zacks mutual fund ranks. And just to touch on this a little bit, it's very important because these are all featured in advisor tools to a varying degree. So clients, for the most part, have access to this. The ETF ranks are the biggest advantage and our differentiator to the ETF ranks is that they mirror the objective of ETFs, which is basically asset allocation. ETFs are a primary instrument used in asset allocation. So what we do is we then mirror that methodology and we say, okay, we need to then use these asset class forecasts as the main inputs into the calculation of these ETF ranks. And the significance to that is great, right? Because nobody else is doing it, A. B, we have a solid process in place with John Blank and his polling. We are not only polling the sell side, but we have relationships with much of the buy side, specifically the CIOs, and we actually poll them as well. And we aggregate all of this polling information and make this available as a document inside advisor tools. And I know I've spoke of the document before and I've showed it. We want to make sure that we're showing clients the document that they can actually review that is driving these forecasts for future asset class returns. Again, John Blank does an excellent job putting this document together for us, and we need to be talking about it. I pulled a little bit of an excerpt out of Advisor Tools from the information icon on our ETF rank to just illustrate what actually goes into the forecast for future asset class returns. It's very extensive. It involves literally everything in the capital markets. It's regional returns. It's large cap, small cap, growth, value, you name it, sectors. It's all geographic regions, all 20 major countries outside the U.S., fixed income, treasury. I mean, it's all encompassing. So to the extent we're experiencing these challenging market times, there's no better place to look than this asset class forecast, and specifically the ETF ranks that are derived off of these forecasts. Now, keep in mind, the ETF rank itself consists of 7 other factors as well, very, very comprehensive. But these should definitely be something that our clients are looking at. When we talk about the mutual fund rank, again, this is something that we have that's very special, very unique to Zacks. We have on the screen right here, I'm showing our U.S. stock model. The differentiator between what we're doing with the mutual fund rank and what everybody else does is that our mutual fund rank itself actually can predict future fund performance. In other words, it does a really, really good job of showing us which funds are more likely to outperform their category average. And I want to share some screenshots that I took literally right out of Advisor Tools, again, from the information icon right out of the mutual fund rank section. And what we're looking at across our 3 models, I've got some slides we're going to go through. This is our U.S. stock model, and these are basically the following year excess returns by the Zacks rating. And you can see that Zacks rank 1 and 2 consistently outperforming the Zacks rank 4s and 5s. And it's the same for the international stock model, following year excess returns, outperformance, fixed income, similar results. So all 3 of our models performing extremely well. One of the most important characteristics of this is that when you look at this performance relative to these Morningstar category averages, the returns themselves are actually durable for upwards of 5 years before they actually begin to mean revert. So when you're looking at the returns, they're persistent, and that's the key. So what we're looking at in this chart, again, we'll start with the U.S. stock model, but these are going to be total excess returns by that Morningstar fund category. And this is obviously going to be on average. And you can see that the returns even accelerate and get better as we move into years 2, 3, 4, and 5. And then ultimately, they will begin to mean revert, but extremely good durability for the mutual fund ranks themselves. International stock model, similar results, again, very persistent, specifically for the Zacks rank 1s, but even the 2s and 3s. And then obviously similar results with fixed income as well. Okay, so the moral of the story with the mutual fund rank that we need to be discussing with our clients is that we literally have them covered. I mean, we're covering 92 Morningstar fund categories, and these are basically evenly distributed into quintiles. So, a 1 to 5 rank. U.S. equity fund categories 23, non-U.S. equity, fixed income, and other categories that are being ranked, there's 69 of them. So to the extent one of our clients are looking to fulfill a particular mandate within their, for a specific asset class, chances are we've got a mutual fund category that we're ranking on. So be sure that we're discussing that. Some of the advantage, obviously, the exposure, the chance of selecting a fund that outperforms the category average will actually increase by over 20% if that selection was made from a Zacks rank 1 versus a Zacks rank 5 fund. They exhibit extremely low turnover, right? So Zacks rank 1 and 2 funds stay buy rated, with 70% of those changing or not changing in any quarter to quarter time period. And this is something that I review specifically with Adam each and every quarter. And probably one of the the most important pieces here is this average return spread. So when you start talking about the spread of returns between a Zacks Rank 1 and 5 fund, in most categories, that ranges from 1 to 2% or even more. So these are really, really powerful facts. So my final thoughts to share with you guys is that for any advisor acting in a fiduciary capacity, these methodologies that I just spoke of with regards to both ETF and mutual fund rank provide an exceptional layer of due diligence, right? And do nothing but increase your odds of outperforming your category average, regardless of whether you're looking at ETFs or funds. And if you're looking at ETFs and funds to fulfill any mandate, specifically fixed income, equity, international, these ranks are a must-have component for your investment process. I talk to advisors every day, and we talk to due diligence teams at broker dealers. We talk to everybody about this stuff, and I'm just shocked at how many people don't use tools like this. So it's our job to educate and make sure that everyone's aware that these tools and the advantages of these tools, that this is available. Moving on to cash. When we start talking about challenging our traditional asset allocation models, obviously in a longer term inflationary environment that we could be looking at post COVID-19, cash is a horrible store of value. We really need to consider other liquid alternatives to cash that can effectively hedge inflation. I've got some ideas up here. I put competitive kind of in quotes with money market accounts. I really question a money market account's ability to be able to keep up with inflation in that type of an environment. But again, a certain allocation towards that would be warranted, but perhaps not as much as we've had in the past. Super short term, short duration, treasury bills, muni bonds, government floating rate debt, and ultra short term corporate bonds. There's ETFs for all of these, and we've got many of these obviously covered in advisor tools. So those are some good suggestions. Also, just like I was mentioning with the bond allocations, we might want to be thinking about lower cash reserves, as well as direct investments in commodities like gold and silver. Those tend to be a really, really good liquid inflationary hedge. So again, we've got commodity ETFs that can be used in this case for various baskets, and those will appreciate with inflation. I like the commodities baskets that are more tied to industrial demand, because obviously with inflation going up, the cyclicals, the industrials, those types of names will be benefiting, and so will any of the commodity baskets and tied to the industrial demand. So the Zacks ETF and fund ranks can obviously help in this area as well. Obviously, my favorite one to talk about when we start challenging traditional asset allocation models is going to be on the equity side, and this is where things are going to get very, very dynamic, very, very quickly, perhaps, as inflation starts to begin creeping into the picture. So this is kind of a double-edged sword for stocks, right? Because stocks are obviously going to remain the preferred asset class in a long-term inflationary environment, but I put in here in all caps, but not all stocks. And we've got to be really careful here, and we need to understand, what's behind all this. So I'm going to do my best to kind of cut through some of the noise and get to some of the points here quickly. We need to understand that PE multiples will contract once equity risk premium decline can no longer absorb the increase in treasury yields. Now, this is going to take some of you back because we haven't really had this discussion in years. But if you roll the tape back many, many years ago to some of my other webinars that I've done entire webinars on equity risk premium's ability to absorb an increase in rates. And I'll do it very quickly here. I've actually got a Zacks research system chart up on the screen. And again, this is our institutional analytics platform where I've got the equity risk premium charted against the 10-year treasury yield. And again, I'm going back to the 1980s. You'll see two red circles on your screen, and these represent channels of equity risk premium. And since 2002, we've been in a very defined channel of 3 to 6. Obviously, after the great financial crisis, we were channeling between 6 and 9, and we quickly reverted back below 6 at the start of 14. So it's very important to look at equity risk premium currently relative to its history, and you want to think of equity risk premium in terms of long-term trend and these channels, okay? So we've got a very distinct channel of equity risk premium between 1 and 3%. And then we've got another channel of equity risk premium between 3 and 6%. And then obviously what I call the crisis channel, whenever we kick into crisis mode, which was obviously this little blip here in March during the COVID crisis, during the peak. And then obviously during the financial crisis, we were in that crisis mode where investors were literally demanding a premium of 6 to 9% to just have their money in the equity basket of securities. And that's what equity risk premium measures. And again, it's measuring weekly that flow of funds, the demand between the equity basket of securities and the risk-free basket of securities or U.S. Treasuries. So the idea here is that you'll see throughout this entire time frame that the 10-year Treasury has just been doing nothing but dropping at the same time that we've been channeling equity risk premium. So the idea is equity risk premium is going to continue to fall, right, to the extent that macroeconomic headline risk continues to decline. And the interesting thing is that these two series are inversely correlated. So as this 10-year Treasury will rise, equity risk premium will be able to offset about 75% of that move to a point, right? So keep in mind that it's the equity risk premium plus the 10-year Treasury yield that drives the total equity discount rate. So again, let me repeat that. As the 10-year Treasury yield begins to rise, as we're expecting post-COVID with all of the stimulus that's been pumped into the system, this rate is going to begin to rise, hopefully back to 2.5%, which would be a lot more normal, gives the Fed more cushion to provide a safety net for us for future pandemics or future economic crises. And when that happens, equity risk premium will be able to absorb a certain percentage of that increase in yield without impacting equity valuations, okay? But it's not much. I have noted up here, we do not have much wiggle room here. And the reason for that is once we dip into this channel between 1 to 3, we're going to be back to that normalized equity risk premium range that we had all the way from 1988 to 2000, where we literally bounced between, 1 and roughly 3. And so looking at this just very, very quickly, you can determine that with the equity risk premium's ability to absorb roughly a 75% of the increase in a Treasury yield move, once we get below an equity risk premium of, say, 2.5 to 3, the equity risk premium is going to be pretty stubborn to get to move much lower. And we've seen this throughout history. And that's what these channels tell us. And so what that means is if you just literally subtract 2.5%, we're currently at 0.65. So let's say we go up another 2%, so that'd be 2.65. 75% of that 2% is about all that equity risk premium would be able to absorb without impacting equity valuation. So somewhere in the neighborhood of perhaps a 1.25% move, let's just say, conservatively speaking. So there is some danger here, and I want to talk about what this looks like. So higher yield equities will obviously get punished as rates rise, not only due to the present value of those cash flows on those dividends, but they'll also be competing with Treasury yields, and that's going to be problematic for the high yield equity space. The interesting thing that's going to happen in growth stocks potentially, and something to pay attention to and look for, and I've got it 2 cases illustrated here. These are classic cases, is that growth stocks could be in for single-digit returns for perhaps even several years as PE multiples contract, even though earnings continue to grow. And this isn't necessarily a bad thing. This is just structural changes going on in the underlying economy, where we call this a valuation catch-up, right? So we had all this stimulus pumped in the system. We had rates just extremely low. PE ratios get extended, and then we go into this period of time where we might channel flat while this earnings line continues to grow, hence that what I call the PE multiple contraction. It's not necessarily that price is declining, it's that earnings continue to grow against price that basically stays flat, or what I'm calling single-digit returns when you include the yield in there. So at any rate, you can see that could be a definite possibility. The next thing I want to mention is that in this case, over-diversification is not going to be your friend. And this really goes back to the point I made earlier, which is it's not going to be all stocks, right? So we're going to have to start picking stocks. Keep in mind the number one source of over-diversification is buying ETFs and mutual funds without really knowing what you're buying. Without having that 100% transparency into constituents of the fund. I mean, you have access to that, but who's really out there looking at all of the overlaps between the funds and how many ETFs do you hold, stock XYZ, and then you're forced to take a lot of bad stocks along with the good stocks. So my point here is that we need to have a very solid methodology in place. We need to stick with our high conviction bets, and we need a high quality strategy. And when you start looking at earnings revisions in aggregate across the S&P 500, this is an example of what over diversification, some of the damage over diversification can do. It shows up everywhere. It shows up in your fund returns, right? You over diversify your portfolio, you basically start reducing your return, and it shows up in estimate revisions, right? So if you're not being targeted in your individual security selections, then you run the risk of what's happening with the S&P 500 right now, where you buy this massive basket of 500 stocks. We all know there's a ton of garbage in there. I've talked about it for months, if not years on end. And you can see that the F1 estimate revisions are still down roughly 25% from October of last year. And so you can see that's a different story when we start talking about the Earnings Certain Admiral portfolio, where we've had literally a full recovery in F1 estimate forecasts. So yes, we went through a little bit of a COVID decline, but guess what? We're right back to where we were. Even pre-COVID, we're actually better off. So the COVID crisis broke out, let's just say in this monthly point, February 29th, we're actually positive a few percent. And you can't say that for the S&P 500. So the problems with over-diversification, they pop up everywhere. They pop up fundamentally. They pop up in your valuation. They pop up in your returns. And it sounds like a good idea, but it's really not. So again, what does that high conviction, higher quality strategy look like? Obviously, the one that I prefer is the Earnings Certain portfolio family of the Zacks models, and start to actually move away from ETF and mutual fund strategies in your core equity. It's fine to use the ETFs and funds for your fixed income allocations, cash, and alternatives, but really try to take a shot at managing your own portfolio. And obviously, the danger here is if you own the SPY and you own a handful of other equity ETFs, you've all of a sudden got exposure to 1,000 plus stocks, and you really don't have any idea what you're holding. Research has proven that optimal equity diversification is somewhere between 20 and 30 stocks, and anything more than that is going to begin to erode your return potential. So the idea is here, how did we get to a place where we accept core equity portfolios constructed with ETFs and mutual funds when combined we have exposure to 1,000 plus stocks in a single portfolio? The ECP Admiral is one example. It's probably one of the most popular model portfolios for core equity that we offer. It's a 30 stock portfolio with 20% allocation across 6 additional tilts for a total stock allocation of 36 stocks. These are extreme high conviction, extreme high quality picks. Right now, the 6 tilt stocks are centric to technology, consumer discretionary, and communication services. But with higher inflation and rising rates, we may want to look at some other tilts. And these are some things I'm obviously working on. Regional banks, right? the old Bank of the Ozarks, U.S. Bank, Fifth Third Bank. I mean, these guys are going to be attractive in a rising rate, rising inflationary environment because of their service models, and their loan books happen to be really, really solid. And regional banks tend to do really, really well in that environment. The big money center banks, JP Morgan, Chase, and Bank of America are obviously best of breed, and they'll stand to benefit. We got to be selective in the REIT space, but again, because they have direct holdings in real estate that will appreciate with inflation, these will be attractive as well. I love the cell tower space, the cannabis growing real estate holding REITs, as well as the data center REITs. These are huge, huge opportunities. We got to use sparingly the business cycle sensitive industrials. We really don't need a lot of exposure there because we've already got a lot of that built into ETP Admiral. But they're not business cycle sensitive. They thrive in any environment. So that's why I say stick to the best of breed. We may end up pulling a few business cycle sensitive tilts to take some opportunities there, but we got to stick to best of breed. Energy is a real problem and will continue to be a problem only because we're experiencing a secular shift in demand for energy. And it's not just the fact that, we are, coming out of a recession or with this COVID crisis and everybody's working from home and the demand for energy is the demand for crude oil is low. It's all this push for alternatives and, green everything, electric vehicles. I like names like NextEra Energy, but again, in the energy space, if we're going to get exposure here, it's only going to be the best of breed and with conviction. We're not going to go out and buy, the XLE or anything like that, the energy ETF. There's just too much garbage in there. We got to be focused. The last thing I want to say here is that we can't fear sector exclusion, right? And we know that the ECP models, we stay away from those tilt sectors and we don't hold those in core. It's okay to tilt with them. We don't hold them in core. And I know I've had a lot of advisors call me and thank me, say, hey, you've given me the courage to abandon some of these sectors that I've never wanted to have exposure in. It's the right way to challenge these traditional asset allocation models. You do not have to take a position in a particular sector just because your benchmark does. There's an opportunity to return massive alpha relative to your benchmark by making a tactical decision to exclude exposure to those sectors. And an idea here is obviously how much exposure do you want to the higher yielding, low growth utility sector in a high inflation, rising interest rate environment? I mean, just think about that for a minute. It's probably not the best idea. So what I wanted to wrap up with here and what I want you guys to remind our clients, our advisors of is that there's really nothing more rewarding than managing your own successful core equity portfolio. And, we've experienced it with clients that have implemented ECP. They know it works. They're loving it. I get nothing but positive feedback. Remind them that we provide all the necessary tools, support, the models, the earnings certain family plus tilts for them to be successful. And we can help them pave the way to becoming their own portfolio manager and managing their own portfolio of core equity securities. So some things to think about as we begin to look past this COVID crisis. Again, today, things look pretty grim, but hopefully there'll be a vaccine soon, and we'll have better therapeutics as each day goes by, and we can put 2020 behind us. And hopefully, fingers crossed, never have to deal with anything like this again. So at any rate, my contact information here, be sure to follow me on not only LinkedIn, but also follow the Zacks Professional Services LinkedIn page as well, and follow us on Twitter. And feel free to email us if you have any questions at all for the clients who end up watching this video. Thank you for your time, and we will go ahead and pick it up from here next week.